Successful investing is about managing risk, not avoiding it. Benjamin Graham. Welcome to Retirement Mentorship, your mentor to and through retirement. I'm your host, Freeman Lindy, Certified Financial Planner. Today, we cover why risk tolerance is stupid. The vast majority of American investors today had to fill out a risk tolerance questionnaire before they were allowed to invest. And the vast majority of those, their entire investment portfolio is based on the answers to that risk tolerance questionnaire. And I'm here to tell you today that this is stupid. That's coming up on part one of a two-part episode on the absolute stupidity of risk tolerance questionnaires. First, the two-min tune-in, primary points of the podcast in the first 2 minutes. There are 3 points today on why investing based on risk tolerance is stupid. Number one, it involves the general misunderstanding of risk versus volatility. We'll review what we covered extensively in episode 13 on the differences between risk and volatility. Number two, investing on actual risk tolerance is okay. The problem comes when we invest on risk tolerance questionnaires and the shortcomings involved in those questionnaires. And number three, risk tolerance questionnaires are not understood. People who take risk tolerance questionnaires don't always understand all the different premises and systems behind the questions, and therefore they answer them incorrectly. We'll walk through an actual risk tolerance questionnaire today on the podcast and explain to you how many issues can arise from taking these questionnaires and not fully understanding what you're answering. That's all coming up today on the Retirement Mentorship Podcast. Investing based on risk tolerance is stupid. As we mentioned in the intro, the vast majority of Americans, almost all of us, had to take a risk tolerance questionnaire before we were allowed to invest. If you've ever had to set up an account anywhere with an advisor or on a 401k or anywhere else, you almost certainly had to fill out a risk tolerance questionnaire. This is a 5 to 10 question, maybe up to 20, where they will ask you various questions about your experience with investing, your time that you have spent investing and will spend investing, and other aspects of your preferences about investing. The idea with the risk tolerance questionnaire is to come up with a portfolio afterwards that will fit your risk tolerance. That is, how much risk are you willing to stomach, and will you abandon the portfolio when the going gets tough, or will you be able to stick with it when volatility comes? It's often posed as a benefit to investors. Look, we want you to invest in equities, but we don't want you to invest in too many equities and panic out in a down market. So we're going to give you a risk tolerance questionnaire, which will help us figure out the percentage of equities versus cash or bonds or other fixed income type investments that we should put in your portfolio and reduce the overall quote unquote risk of the portfolio. That way, when tough times happen, it should be inside of your tolerance for risk and you should stick to the plan. It's helping you, investor, invest more wisely. But risk tolerance questionnaires were not built to save investors. They were built to save the companies doing the investing. Too many investors had come back and had sued different investment firms and advisory firms for putting them in too risky of portfolios they didn't understand, and they had lost too much money. And so the risk tolerance questionnaire, which we are going to shorthand to RTQ, it was developed to allow companies some plausible deniability on these investments. When clients, after they had filled out an RTQ, came back and tried to sue the firms because they had lost money, they said, no, look, you filled out this risk tolerance questionnaire. We built a portfolio based on that. This was inside your risk tolerance. If you didn't like the way it turned out, it's because you lied on the risk tolerance questionnaire. And so it was a little bit of a CYA, a cover your butt for the investment firms and the advisory firms, and so that they could cover themselves if and when clients lost money. It was not built to save investors. It was built to save companies. Many of the questions on it involve risk and contain the word risk in it. What would happen if you lost money and if your money was at risk, and how much risk can you stomach? And that leads me to my first point, which we're only going to cover briefly, which is that there is a general misunderstanding of risk versus volatility. Many of the questions should be phrased differently because the way that they are explained makes people think that they are at risk of losing all their money permanently forever. We covered this extensively in episode 13. If you haven't listened to that, go back and give it a listen. It's a crucial one in the difference between risk versus volatility. But if you're in a mainstream investing, if you're in a 401k where it's all going to be mainstream mutual funds, or you're investing with an advisor or even on your own, and you're doing it in mainstream exchange traded funds and mutual funds that are based and invested in the main companies of the United States and around the world, and not any of this fringe stuff or options or currency trading or any of that, then the actual risk of losing all your money is almost nothing. If you invested, for example, in the top 5,000 companies in the United States, the risk of your money going to zero is zero. If your money actually did go to zero, that means the entire world collapsed and your money wouldn't be worth anything anyways. Neither would gold or any other options that you could put your money in. And so when it comes to the risk of investing in mainstream equities and in mainstream equity funds, the risk of your money going to zero is zero. The risk of your money going down in value temporarily can be high, but that's not a risk of losing. When people hear the word risk and investment risk, they often think of it as the risk of them losing all their money. The risk that they will put in $100,000 and it will all go away. Or perhaps even the risk of putting in a bunch of money, $100,000 say, and it dropping in half and simply never recovering. Maybe you don't lose all your money, but you lose a good portion of it and it never comes back. Again, the risk of this happening, the chances, I should say, of this happening in a mainstream equity portfolio is basically nothing. It has never happened before, and there's no reason to think that will happen again. And if it were to happen again, if you were investing in the top 5,000 companies in the United States and they all got cut in half and never came back, we have much, much bigger problems than your retirement portfolio. And so these risks, risk of your money going to zero, or even the risk of your money going down significantly in value and not coming back, are basically zero. And that's what most people think of when they hear the word risk. What often the risk tolerance questionnaires are talking about is not the risk of losing your money, but rather the volatility of your money. What is your tolerance for your money being volatile, for it increasing and decreasing in value rapidly? Can you withstand the temporary decline in the value of your money? But that's not the way it's framed. It's framed as risk, not volatility. And because people don't understand the difference of that, they're automatically set up to answer these questionnaires incorrectly. It's a basic problem with our definitions. The definitions that the investing world uses are not the same definitions that the investing population hears. And so my first point on why risk tolerance questionnaires are dumb is that there's a general misunderstanding of risk versus volatility. Again, go listen to episode 13 if you haven't yet for a deeper dive into this notion. Point number 2, investing on actual risk tolerance is okay. There are differences with people's abilities to withstand volatility. Let's use volatility instead of risk for this section, since that's mostly what RTQs are asking about. Different people can withstand different swings in the value of their funds, knowing that it will come back. People have different abilities to withstand volatility. We call it your volatility quotient or your VolatiQ. How much can you withstand seeing your money temporarily swing in value? And especially if you have other things in place and a full investment plan in place, does that plan help you increase your ability to watch your money fluctuate in value? Now, no matter how much planning you do and what a great investment plan you have, and especially if it's accompanied by an entire financial plan, there will still be differences in people's ability to tolerate volatility. And so basing your total investment portfolio and your investment plan on individuals' individual ability to withstand volatility is okay. That's a good thing to do. And it is also okay to base people's investment portfolio on their actual appetite for risk. And when I say risk, I mean real risk. As in, do you want to take the risk of you actually losing all your money in this cryptocurrency in exchange for perhaps a huge rate of return that you cannot get in the general equity markets? That's a real risk, and people have different appetites for that. Take me, for example. I'm an equity evangelist. I love mainstream equities and investing in them over long periods of time and all the great gains that come with it. But I really have no appetite for risky moves, such as investing in untested new developments, in companies that are startups, and cryptocurrencies and currency trading and all these other types of quote unquote investing, which is more speculation. More on that in another episode. And those are all have a very real risk of losing your money or having it cut down significantly and never return. And I don't have much of an appetite for that. Or at least that is to say, I have no reason to do that when I know for sure that equity investing over long periods of time, with a proper investment plan, is a far superior method of growing wealth and achieving your goals. And so investing based on people's actual risk tolerance is an okay thing. It's not the best. I prefer an actual investment plan, not just based on your risk tolerance, but it's an okay thing to do. So the problem isn't on investing based on your risk tolerance. The problem is investing based on the answers to a risk tolerance questionnaire. This is the problem. And that leads us to our last point, that risk tolerance questionnaires are not understood. RTQs are just given out to people, often with no prior investment education, or at least insufficient investment education, and they're commanded to fill these out, and then everything is based on the answers to these simple questionnaires. But people don't understand the questions themselves. They don't understand the premises behind them. They don't understand the terms. They don't understand the definitions, or they have different definitions. And so you are giving people a questionnaire that is not comprehensive, that is not understood, and basing their entire investment portfolio off this. That is dumb. That is stupid. People need to understand and believe in their investment plan for them to stick with it. And you are never going to get that simply from an RTQ. So let's walk through a risk tolerance questionnaire and see what I mean by investing based on these is stupid. We're going to go through an actual risk tolerance questionnaire that is used by an actual broker-dealer, and that is that they are required to have every single client of this broker-dealer fill one of these out before they are allowed to invest. And all the portfolios that they have are based on these risk tolerance questionnaires. We'll cover that a little bit more in next week, but for now, let's just go through the RTQ, and I'll explain a little bit more of what I want. This particular RTQ is 10 questions long, and so let's just go through each one of them. It's not a very sophisticated one, meaning that the earlier you answer, so they're all A, B, C, D, and maybe E answers, multiple choice. And if you answer A for all of them, you're going to end up with a portfolio that's basically entirely cash and bonds. And if you answer D or E for all of them, then you're allowed to have a portfolio that has a majority or all equities. And so it's just the earlier you answer A's or B's, the more conservative or more fixed income will be in your portfolio. And the later you answer D's or E's, the more equities you're allowed to have in your portfolio. So let's go through this. Question number 1. How soon do you plan to begin withdrawing the money in this portfolio? And then it goes from 1 to 3, 4 to 9, 10 to 15, and over 15 years. And so if you plan to withdraw the money in 1 to 3 years, then you answer A, and you only get a few points towards your risk tolerance. And if you do D over 15 years, then you get a lot of points towards your risk tolerance. And the more points you have at the end, the greater amount of equities you can have. The problem with this is that there's absolutely no nuance to this question. For example, let's say that you have someone with a portfolio that's one of many different accounts that someone might have for retirement. But with this particular account, which they have to fill out this RTQ for, they plan to start pulling money out of this immediately. They're in retirement. They're going to start pulling this out of retirement, but they want the portfolio to be their growth bucket. They want it to be something that grows and can be used for the future. But they'd also like the ability to draw out of it right now. They plan to live on this. They've got other backup portfolios, other types of accounts that aren't volatile, that don't have all the money in equities that they can pull from when equities are down. But in the meantime, they do plan to pull from this portfolio right away. So they might answer A, 1 to 3 years, because they plan to take money from this portfolio right away. But they don't have to. But if they answer A, this portfolio automatically is going to force them to have at least some cash and bonds in this portfolio, even though they may have sufficient cash and bonds elsewhere. But the fact that they do, in fact, want to withdraw from this in 1 to 3 years is forcing them to an outcome they may not necessarily need in their overall financial plan or investment plan. So even though on the face of it seems great, if you're going to pull out early, you want some money in cash and bonds. And if you've got a long time horizon, you want more equities. Seems reasonable, but there's no nuance. And so for a lot of people, it's not going to fit. Question number 2, how many years do you expect to withdraw money in this portfolio? And that goes from less than a year to 1 to 3 years, 4 to 9 years, 10 to 15 years, and over 15 years. Again, if you're withdrawing less than 1 year, then it's going to give you very low points for your overall portfolio and force you into a lot more cash and bonds. And if you say over 15 years, then it's going to allow you to have more equities. This question is not so bad. If you're planning to withdraw all the money in this portfolio in less than a year, then yes, you probably shouldn't have any of it in equities. That should all be in cash and bonds. And if it's going to be over 15 years, then yes, you should have all of it in equities. So this question is not so bad. We'll just move right along. Question number 3. And this one is your portfolio investment objectives. This one's a more advanced question where it gives you basically 5 different types. And it goes from capital preservation to income to growth in income to growth, and then finally aggressive growth. And so it gives you kind of a definition for each one, and you pick the one that most fits you. And so with the first one, capital preservation, it says, my primary investment objective is capital preservation. I'm a conservative investor. My risk tolerance is very low. I seek to preserve my capital, and I'm not willing to accept risk to my capital in order to grow my portfolio. I'm willing to accept lower returns to preserve my portfolio and capital. If you answer A in this one, capital preservation, you automatically are eliminated from having a lot of equities in your portfolio. It's going to force you to take a lot of cash and bonds. And maybe that's right based on this. But this is where, again, we come to people are not educated often when they take these risk tolerance questionnaires. And they use definitions and words that will mean different things to different people. So in this first one, I am a quote-unquote conservative investor versus the last one, an aggressive investor. That means different things to different people. I've had some people who said they were conservative and they wanted 100% equities, but they just wanted it in like the S&P 500 and the Wilshire 5000, just mainstream equities. To them, that meant they were conservative. They didn't want any Bitcoin or to trade currencies or to invest in small Chinese startups. That was conservative to them. Meanwhile, I've had other people that thought they were aggressive investors and they wanted up to 50% of their total portfolio invested in equities and the rest in cash and bonds. And to them, that meant that they were being aggressive. So right away, different definitions will result in different outcomes. And then it goes on. Again, the definition of capital preservation. My risk tolerance is very low. Again, what does that even mean? Tolerance for risk, your tolerance for losing all your money? Most people's tolerance for losing all their money is very low. Almost nobody is like, yeah, I could tolerate losing all my money. It's a problem with the definition of risk. It goes on. I seek to preserve my capital and I'm not willing to accept risk to my capital in order for it to grow. Again, if your definition of risk is I'm not willing to accept losing all my money in order to grow it, that seems reasonable to me. Most people should be that way. If, however, your definition of risk is volatility, then we have a different story. Are you willing to accept temporary decreases in your investment portfolio in order to see long-term growth. And then it goes on to say, I'm willing to accept lower returns to preserve my portfolio and capital. And this gets into a whole retirement, especially retirement planning scenario and long-term investing scenario, where if you think that the best way to preserve your portfolio is to have it all in cash and bonds, while inflation eats away at it at a faster and faster rate, then you may have the wrong definition of conservative and preserving your portfolio. Perhaps the best way to preserve your portfolio is to invest it in equities. That way inflation can't eat it for breakfast. But again, not knowing this, not understanding investing, not being yet educated, because it's not required anywhere for you to be educated on investing, you might think this definition applies to you and pick this not knowing that this would be all wrong for you. I'm not going to go through all the definitions of all of these, but even some of the original definitions, without diving into it, can be confusing. You have B, income, meaning that you want to take income off your portfolio, versus maybe aggressive growth. If you're in retirement, you often think, well, yes, I want income. We had a whole episode on having retirement income that you can't outlast in your retirement. So maybe you would pick that, not realizing that what that's going to do is have you in a bunch of bonds that have bond income, but maybe not enough equities to produce the growth and long-term income that you need. And so while these questions at its face may seem reasonable, when you dive into it and when you take into the variance that people have with the different definitions and the different levels of education people have taking this, it becomes quite obvious that this RTQ and these questions alone are inadequate to properly equip people to invest. And again, this is the problem. People will use RTQs and nothing else in order to have people invest. Especially if you're not working with an advisor, if you're doing it yourself and you're going on to Vanguard or Fidelity or Schwab or anywhere else, and you are simply filling out a risk tolerance questionnaire and it is generating a portfolio for you, then you are missing out and possibly not understanding all the questions and how you should actually be answering for your situation. Let's move on. What do you expect your total income and investment earnings to do over the next 10 years? And that goes from decline significantly to increase substantially. Relative to what? Relative to right now? Relative to inflation? Who knows? Maybe people think, hey, I'm comfortable with income right now. I don't need it to increase substantially. But from a raw perspective, you do, because inflation and your expenses will increase substantially. And so you need your income to increase substantially as well in order to overcome that inflation. Not knowing that may cause you to answer incorrectly to this question for what you actually need. Number 5, I would best describe my tolerance for capital fluctuation as, and it goes from very low to moderate to very high. And this might be actually the best question on here, where it really is differentiating between capital fluctuation and the risk of losing your money. I don't have too many problems with that question. Number 6, if changes to your investments within your portfolio result in more fluctuation, but could increase your returns and risk, would you, and it goes from A, be unlikely to take more risk, or D, be willing to take a lot more risk with my entire portfolio? What does that mean? You already have more fluctuation, and then more fluctuation causing more risk? Is that the same thing here, or are you talking about a different kind of risk? If you're talking about a different kind of risk, we might not want any of that kind of risk in our portfolio if we're already increasing the risk of fluctuation through mainstream equity investing. Just more issues with the way that the questions are phrased and how you might interpret them. Then it has kind of a 2-part question here, 7 and 8. It goes like this. If your portfolio valued at $50,000 declined in value to $39,000 within a 1 year, what would you most likely do? So it's a 22% decline. If it went from $50,000 down to $39,000, what would you do? And then the answers are A, sell all the positions and move the money to a safer investments. B, sell only the losing investments. C, sell nothing. And D, buy more as the losing investments may represent opportunity. Now, to me, this question represents a good opportunity to see where people are at and to do some education, not as an opportunity to invest based on this. And part of that is that people answer questions differently on a questionnaire than they would in real life. We'll touch on that a lot more in the future, but this question in particular that we'll cover again next week is the basis for a lot of issues. It's one thing to answer this when you're comfortably sitting in an office about to partake in an investment journey, and it's quite another thing after a year of your money going down in value and what you would actually do versus what you said you would do. And then part 2 of that, number 8, is if the portfolio above declined an additional 10% to $35,000 the following year, what would you most likely do? And it has the same questions. So again, an opportunity perhaps to educate people on the difference between temporary declines and permanent loss, but not a reason to invest people based on their answers to these questions sitting in your comfortable office or sitting at home as you do something like this online. Number 9, when it comes to investing, I would describe myself as, and then has a range of anywhere from A, an investor with no or limited knowledge about investing or investment experience, to D, an investor with vast knowledge about investing and extensive investment experience. This is not a bad question. The more experience you have, the more knowledge you have, the better, for sure. So no issues there. And then the last question, number 10, which of the following best describes how I monitor and review my investments? And number A, I do not monitor and review my investments. B, I have not monitored or reviewed my investments since I originally invested. C, I monitor and review my investments occasionally, but not regularly. And D, I monitor and review my investments regularly. A couple quick issues I have with this question. What does regularly mean? Regularly as in daily, as in weekly, as in annually? You could review and monitor your investments once a decade. That would still be regularly, but that's a far cry from once a day, which is also regular. And also, why does checking on your investments more regularly mean that you should have more equity exposure, which is what this insinuates? The more often you check your portfolio, the more equities you're allowed to have for this broker-dealer. When in fact, a lot of the science suggests that those who check their portfolios extensively make more errors and trade out and lose more money than those people who don't check their investments and just let them go to work. We often recommend that people should check their investments at least annually, but no more than quarterly. For someone who monitors and reviews their investments regularly, as in daily, they should probably have less equities in their portfolio than someone who only reviews them occasionally, but not regularly. So as we go through this and we describe the differences in how you might interpret these questions and how you might answer them, you can see how, if the only basis for your entire investing future is the answers to 5 to 10 of these questions, which people are going to answer differently, that is just simply insufficient. It is stupid to choose all your investments based on a risk tolerance questionnaire. Let me say that again in case I was not clear. It is stupid to make all your investing decisions based on your answers to a risk tolerance questionnaire. You need more than that. What do we need? Well, we're going to cover that next week. Next week is part 2 of our Investing Based on Risk Tolerance is Stupid 2-part episode. And we'll be covering a few more of the issues with risk tolerance questionnaires and then providing the solution. What do we do instead? If investing based on RTQs is so dumb, what is the proper solution? That is coming up next week on the Retirement Mentorship Podcast, and we'll see you next week. This podcast is educational only and is not intended to be investment, legal, or tax advice or recommendations, whether direct or incidental. Again, this is not investment advice. Consult your financial, tax, and legal professionals for specific advice related to your specific situation. Never take investment advice from someone who doesn't know you and your specific situation. All opinions expressed in this podcast are the opinions of the speakers expressing them. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Retirement Mentorship is not affiliated with or controlled by any registered investment advisor, broker-dealer, or other financial services company.